Modern monetary theory, while it's not openly discussed, seems to be one of the frameworks increasingly used as quasi-taxation through our monetary system. My name is Darcy Ongaro, and you're watching the NZ Everyday Investor. Subscribe to the channel if you want to learn, along with me, how the financial system works, but more importantly, how it can work for you and not against you. Now, we like to think that when we borrow money, in fact, we're taught this, that money is simply transferred from savers to borrowers, and banks act as intermediaries. While it's partially true, it's potentially more true that new money is created every time you take out a loan from the bank, out of thin air. Now, under the cover of technology-induced deflation, for decades, new money creation by retail banks and also our central bank has run rampant, and with no significant impact on consumer price inflation, CPI. Well, not yet at least. Now, I should mention here that in the context of investing, we all face the temptation to focus on what's not actually that important. I'm of the view that 90% of your wealth can be made by simply focusing on your microeconomic considerations, spending less than you earn, investing the difference over time in a thoughtfully designed portfolio. That's how you're likely to get the job done. But 10% of your wealth can be made or lost, therefore, by understanding and adapting to macroeconomic considerations, like what we're covering today. Now, what we've observed in the last 12 months is that an increased money supply assisted by retail bank lending on property and central banks issuing new currency does indeed have consequences. It appears first in the giant sponges of our financial markets. Property markets and equity markets have boomed, along with justified cries of anguish from those with no assets behind them to inflate. What we're currently witnessing, I think, around the world is a willingness to use more debt to create economic growth. Now remember, we need this growth if we want a sustained increase in our portfolio of investments. If debt exceeds production of an economy, inevitably we, or our children, are going to face a day of reckoning at some point in the future. So will the government further increase taxes? Will they spend less? No and no is my guess. So what if they simply issue new currency instead? If you can issue your own currency, like New Zealand can, you can never become insolvent. But there are limits: loss of confidence in the system and inflation. And from what I can see, and yes, I'm very much still learning here, we've either cracked the code and discovered a way to create energy out of nothing, or we're going down a very dangerous path. And if we're going down the wrong path, how can we get back to where we should be? Oliver Hartwich is my guest today. Oliver is the executive director of the NZ Initiative, the think tank supported by CEOs of some of New Zealand's largest companies. He's also a public policy researcher and economics commentator, originally from Germany, but soon to become a New Zealand citizen. Now, I hope you enjoy this one, and remember to have a look in the notes in the description for a link to sign up to Hatch. If you want to invest in the US share markets as part of your overall investment strategy, check them out. Using that link will get you a $20 credit for the first $100 that you deposit into a brand new Hatch account. Let's make a start now. Cool. Welcome to the show today, Oliver Hartwich. Thanks for joining me.
Thanks for having me.
Now, as a bit of a background, you've been on the show before, but for those who are just kind of catching up with who Oliver Hartwich is, you are the executive director of the NZ Initiative, a think tank supported by chief executives of New Zealand's largest companies. And you're also a public policy researcher and economics commentator with experience in Germany, Britain, Australia, and New Zealand. And as you were saying before we hit record, you are officially going to be a New Zealand citizen as well from next week. So congratulations on that.
Thank you very much. It was a long process, but it feels like after 9 years in the country, I finally arrived home.
Fantastic. That's really good. So what we're going to talk about today is I want to talk a little bit more about something that we loosely touched on the last time that we caught up a few months ago. I want to zoom in on this whole concept of money versus wealth, money creation versus economic growth. How do those things actually play off each other? And we've seen a pretty crazy last 12 months, especially in the area of new money creation as that happens. And that has created things like inequality, distortions around inflation, what that really means. And so I just want to unpack that a little bit. So maybe the best starting point would be, how does money get created? Where does it come from?
Okay, if you want to take that question and you take a very long-term view at what money is and how it got created, well, I think actually money wasn't so much created. Money was found. It was invented. It just happened to be defined. What I mean by that is that if you're going back thousands of years, people had a barter economy. They traded a cow for a cloth, for example, and then they found that was a bit unpractical. And so over time, people found that there are some means of exchange that everybody accepts. And if you want to find something that is easily exchangeable, it should be easy to divide. It should not perish, of course, because otherwise you can't store value in these things. It should be something that everybody desires and that everybody wants to have. And it should be easy to transport. So it's no point actually having a money system based on cows, for example, because it's really heavy. So what they found over time, and we're talking really about 4,000 or 5,000 years ago, people found that gold, silver, precious metals, generally speaking, were pretty good for all of this because they didn't perish. You could easily divide them. People really wanted them. And over time, people started actually turning these precious metals into coins. And it was only afterwards that emperors and kings actually started to mint them and put their own pictures on these coins. But it actually started with gold. It started with some real value that people accepted as a store of value. So the idea that money was just invented by the government, by a central bank, by the state, by a king, by an emperor, that's just not true. Actually, it happened a lot earlier, much before that. And so we've had these precious metal currencies or precious metal backed currencies for thousands of years. And we've only finally deviated from that in the 1970s. That was when Richard Nixon, as US president, really cut the US dollar, the final link to gold, because the Americans had just spent too much, and so they could no longer maintain that link to gold. That was the end of the gold standard, and we just have to realize that what we've experienced in the last 50 years is so unusual by historical standards, because before that, it was always a link to, as I said, gold, silver, or at least anything in the real economy. For the past 50 years, we've been flying without that anchor in the real world, and I think that experiment hasn't worked particularly well.
Do you think it worked to some degree? Do you think it did some good, kind of severing that connection?
Well, it did work in some places. It worked in those places where at least you had independent central banks committed to just price stability. So where the central bank was still trying to keep the value of money stable, that generally worked a lot better than in others, where central banks followed political dictates and wishes and tried to influence the business cycle and employment and other targets. So where central banks kept money stable because that was their only goal, it worked reasonably well. And still, I think what you can see if you're looking at the last 50 years of monetary history and global economic history, we've had severe crises, and I think these crises are becoming more frequent and they're becoming worse over time. I think it started, of course, with the big stagflation period in the 70s. We had a stock market crash in 1987. We had the Russia crisis, the Asian crisis in the 1990s. We had the bust of the dot-com bubble in the early 2000s. And then, of course, we had the GFC, and I think we're now heading for another crisis post-corona. So what you can see is these crises are getting bigger. You can also see this, of course, on the balance sheets of our large central banks. They have ballooned, and I don't think it's a particularly healthy development, and I'm not convinced it is sustainable.
So as those ties have been severed, there's been a lot more expansion in the monetary supply because there hasn't been a need to always bring it back to something that's finite, something that is like gold, right? And
that's
so,
right. And of course, indeed, there's nothing that limits a bank's ability to just intervene. If you previously had a link, of course, to gold, you couldn't intervene at will. Once you get rid of the gold link, of course, you can print as much money as you like, or you can just basically provide that money electronically. Of course, nowadays you don't even have to print it anymore. And we can see this, of course, in the US case quite clearly. There was the Greenspan put, so the stock market was never allowed to crash completely. The economy was never allowed to crash completely. In the end, the central bank would just intervene, provide some extra liquidity, and try to bail out the market time and again. And you can do that for a while, but at some stage, of course, the market needs to correct.
Right. And the more intervention there is, effectively, the more wildly we'll see these market corrections potentially in the future.
That's right. And it's not just that. It's also that, of course, we are never quite clearing the market. We will then, with each wave of bailouts, create more zombie firms. So firms that can only survive because of ultra easy monetary policy. So in previous times, of course, there was something like creative destruction. I mean, Joseph Schumpeter, the great Austrian economist, talked about this. And the idea was that in a crisis, the market clears out some companies that are no longer competitive, that are no longer productive enough. And out of the ruins of these companies, if you like, new companies will come with different products, different methods of production, and they will innovate. Now, the thing is, if you preserve the market structure as it is, if the central bank just intervenes, provides the money to keep these companies alive, that process of creative destruction simply doesn't happen. And what we see is that we'll have some companies left in the market that under other circumstances would have disappeared a long time ago. We'll also see, of course, that the productive capacity of the economy shrinks, and certainly the innovative capacity. So economies simply don't regenerate anymore. And I think you can see this in Japan, you can already see it in Europe, and that is the result of this monetary system.
Creative destruction is messy, but so is capitalism, right? It's sometimes there's death involved, but it does lead to, I guess, periodically it leads to the reallocation of capital towards innovative new things where there is life in it. And what we've kind of seen is that this almost like a helicopter parent style way of preserving people from the downside of these market corrections exacerbates, it causes a greater wave or a greater risk of waves of that crashing in the future and misallocating capital and ultimately leading to lower growth. Is that potentially the outcome here, right?
That is the outcome. It's an ossification of the structure of production. There's another outcome, of course. It becomes very political. So central banks are playing the role of a central planner, trying to control how the economy is doing, whereas, of course, in previous times, that would have been for the market to decide. The market would have actually figured out the price level, the level of interest rates, and it would have eventually also then determined the structure of production. But once you intervene, once you let central banks play the role of the central planner, you get into all sorts of problems that we know from central planning economies. It's quite ironic, actually, that people think we are living in this great capitalist system. Well, in some ways we do, but in the crucial aspect of the market economy, money and the money supply, this isn't really a free market. It is actually more like a centrally planned economy.
The price signals are, I guess, so heavily polluted or interfered with that the market participants can't necessarily do their jobs in a free way, because I guess we're always trying to anticipate how it's going to be manipulated, right? Like if the cost of money is going to be suppressed, if the supply of money is going to be increased, and all these other controls are going on, then the participants in the market need to almost anticipate those pieces rather than actually focusing on production and output and all those good things, right?
That's exactly right. That's what's happening. And it's not the only negative side effect. Of course, the other one is that with this kind of intervention, we are creating business cycles. Again, this is not a new discovery. Friedrich Hayek wrote about this in the 1920s. And Ludwig Mises did as well. So basically what's happening is that central banks create money out of thin air. The first people who get this newly created money, they get the full value of it. But people at later stages of production, they receive money that is actually not worth that much anymore, because we'll have price inflation. And so what you create is a structural imbalance. And you create business cycles out of that. And at some stage, the market needs to clear this malinvestment. That was basically the Austrian business cycle theory that Hayek and Mises developed in the 1920s and 30s, and for which Hayek eventually then got the Nobel Prize in economics. So there are all sorts of negative side effects of this monetary socialism or monetary planning, if you like. And Hayek, of course, in his later life wrote about this and said, actually, this is the one thing that we still need to fix in the economy, to take basically the state or central banks out of the money supply and bring the market back in and let the market actually deal with that. And Hayek talked about the denationalization of money. And at the time, that was not a majority position. I think it still isn't a majority position. It was seen as a fringe view. But what happened since in the last few decades, I think, confirms Hayek more and more. And I think we're getting to that point where more people realized that Hayek really was onto something when he talked about that.
So let's kind of tackle this from so we'll zoom back out and come at from a different angle here and talk about a role of a central bank in an economy, because what we've seen, especially in the last 12 months again, is maybe almost what I would, and maybe this isn't necessarily a correct view, but it almost feels like there's a convergence between the role of government and the central bank. And it feels like the relationship is getting closer and closer and closer and closer. How important is it, though, that there is that separation between central bank and state?
Well, for me, I think this is one of the crucial aspects in the structure of the economy. And I say that, of course, as someone coming from Germany. In Germany, we've had two hyperinflations over the course of the 20th century. We had one in the Weimar Republic, and that basically robbed savers of their savings and their life's worth, really. It was taken away from them because there was a crazy hyperinflation in Weimar Germany. And then, of course, just a few decades later, they got the same experience again after the Second World War, when the old Reichsmark was also worthless because the Nazis had inflated money supply just as well. So within the space of just about 25 years, German savers lost their whole savings twice. And the lesson drawn from that in Germany was to give the new Bundesbank A, complete independence, and B, a mandate just to look at price stability. And you know what? It worked. So out of the shambles of history, the Germans actually learned the right lesson and created the most stable currency that Western Europe had ever seen. Now, if you apply this now to the situation today, what we are seeing now is we're deviating quite a lot from that, and we're actually moving closer to the previous experience of Weimar Germany. I mean, not quite as bad, of course, but we have a lot of political interference. And if you just look at the Reserve Bank of New Zealand, I mean, the Reserve Bank of New Zealand, of course, initially got a price stability mandate after the 1984 reforms. So the bank got independence, it got a price stability target, initially between 0 and 2%. Now it's between 1 and 3%. But the last few years have seen a change in this mandate. So what the current government did was they also tasked the central bank with achieving full employment effectively. And in the last few months, the central bank was also then tasked with working towards a more sustainable housing market, more affordable housing market. So what we see is that the central bank gets more and more political targets. At the same time, the central bank is also making itself more political. So it's talking a lot about things that actually do not really have much to do with monetary policy in the first place, like climate change or the Maori economy. I mean, all worthwhile topics in themselves, but political topics and not topics you would typically see dealt with by a central bank. And so I think it is quite a dangerous development to see how reserve banks, central banks, initially tasked with just price stability, are now de facto becoming subsidiaries to the Ministry of Finance, the Treasury. And in doing so, I think they lose their focus on price stability and they become fundamentally even more political institutions.
So almost effectively becoming an agent of the government, and instead of the government dealing on the fiscal side and then the Reserve Bank dealing to the monetary side, it's now that monetary is powered basically by political influences. Is that right?
Yes, that's right. And I think it actually works both ways. It's not just that there is a political influence on the bank. It's actually that we have a Reserve Bank governor who behaves in many ways like a politician. So if you read the speeches coming out of the Reserve Bank, especially by Governor Orr, what you get as an impression is that Orr actually likes to behave like a politician. So he tells politicians that, for example, he thinks we should spend more on infrastructure. Well, it's very nice for him to have that view, except he can have it as a private citizen. As governor of the Reserve Bank, this is none of his business. This he has to leave to the Minister of Finance and to Cabinet to decide what level of infrastructure spending we have. So I think we're seeing a very unhealthy mixing of different aspects of policy. I'm a traditionalist in that sense. I think you should keep monetary policy and fiscal policy apart, because if you mix them with each other, you're asking for trouble.
And I guess this is important, right? Because Adrian Orr isn't, I didn't vote for him. I don't know if you voted for him. I don't know if we can vote for him, right? That's the issue. And so you have all these weird sort of dynamics, and because it doesn't happen quickly and there's no one-off kind of bam, it's changed. It's this slow kind of boiling of the frog, and no one really knows what's going on. And I guess it's almost made worse with the fact that many of us probably don't have a very good understanding based from history as to how this has happened in the past and what the outcomes are. You mentioned the Weimar Republic, and there's other cases. It's not just that. There's a lot of cases where this sort of stuff creates hyperinflation, and that's a pretty dramatic word to throw out there. Hyperinflation as the ultimate negative outcome that this could all lead to. I've had people tell me in the past, hyperinflation, it's absolutely ridiculous to even mention that, because you need a significant event to trigger that. And I don't know whether the pandemic is significant enough. To me, it feels pretty significant. But just to tackle that really quickly, like, how likely is it that an economy like New Zealand could potentially experience either significant inflation or, dare I say, hyperinflation?
Let me start with your first remark.
Yeah.
You said you didn't vote for the governor. Well, I didn't either. In fact, nobody does. But they're behaving more and more like politicians, these Reserve Bank governors around the world. Just yesterday, for example, the governor of the European Central Bank actually started commenting on German domestic politics and talked about how much she liked the Greens candidate for the chancellery. Well, again, this might be her personal opinion, but it's nothing to do for a central bank governor. And in a similar way, as I mentioned before, we see the same politicization here in New Zealand, where Adrian Orr seems to have positions on everything from climate change to our economy to infrastructure investment. So he's actually playing the role of a de facto finance minister. On your broader question, whether hyperinflation is possible or likely, I wouldn't say it is likely, but I think that the time of relative monetary stability is probably over, because we have actually created so much money in New Zealand through quantitative easing that at some stage this money will flood into the ordinary transactions. So far, we've seen the effects, of course, in asset prices. We've seen it in the stock market. We've seen it, of course, in house prices. That's where the money has gone. But if you just think about the enormous quantity of money provided, in New Zealand's case, it's $100 billion QE, quantitative easing. That's about $20,000 per man, woman, and child in the country. So the equivalent of a small car per person. Once this money actually goes into circulation, we can expect inflation rates, as measured by the consumer price index, to go up. Other thing I would say about that is I don't think that this hyperinflation scenario that you mentioned would necessarily have to start in New Zealand. What I think is much more likely, but I'm not giving you a time frame for this, is that at some stage, people in, say, Europe, where the ECB has really increased its balance sheet dramatically, or in the US, same with the Fed, or in England with the Bank of England, start questioning whether money is still stable, whether they can still trust the money they have in their wallets or in their accounts. And that is a dangerous development, because once people start losing that trust, it can actually unravel quite quickly. In economics, I think we often think that things can't last much longer, and then they do. So economists are very bad at saying how long things can last. Economists often think, well, this is unsustainable, this is unhealthy, it will have to come to an end. And then we're disappointed almost as economists when these things take a long time. However, when they start to unravel, they unravel much more quickly than even economists would see. So economists are very bad at the timing stuff. We think this would come to an end very soon because it is unsustainable, because we can see it. Then it takes a long time, but when it actually unravels, it happens very fast. Think about it this way. There are political scenarios which would cause quite a bit of uncertainty in monetary markets. Think about what would happen if France next year elected a president, Marine Le Pen. Marine Le Pen previously wanted to take France out of the EU. She wanted to take it out of the Eurozone as well. Now that would have severe implications across Europe. A similar scenario could unfold in Italy. Italy is, of course, heavily indebted, but currently led by Mario Draghi as a former president of the European Central Bank, so that probably helps the Italians, but they've had their fair share of populists in the past, starting with Silvio Berlusconi, then with Beppe Grillo from the Five Star Movement, and then with Matteo Salvini as well from the Lega. So there's always a possibility that something will go wrong in these big Eurozone economies, and if you just keep in mind, even a small economy like Greece was seen as systemic to the survival of the Eurozone. I mean, even Cyprus for a while was seen as systemic for the survival of the Eurozone. Now, if a large economy like France or Italy started to wobble, this whole project could unravel. And of course, we would feel the implications of that here.
Yeah. And I guess this is an interesting one, and vaguely connected to this, I guess, is, well, not vaguely, I guess central to this discussion is trust in institutions, trust in our dollars, right? Whether it's the euro, the New Zealand dollar, or even the US dollar. So, thinking about the US, for example, I know, again, like what you were saying before about economists, they can kind of see things, but they can't predict the timing. I think a lot of people would be of the opinion that the scale of new money creation in the United States will ultimately lead to some sort of loss in faith in the US dollar. But considering it is the worldwide reserve currency, surely that's got a long way to go before that potentially comes to a head. Where would the US be in terms of that loss in confidence in the US dollar, do you think?
First of all, there's no guarantee that a currency will always be a reserve currency. I mean, go back into history and see the change from sterling, for example, to the US dollar. And you can see that the previously leading power, Britain, of course, got replaced by the Americans, and quite swiftly. So there's no guarantee that we will always have the US dollar as the world lead currency. However, again, timing, of course, is difficult to predict. I mean, what could trigger a loss of faith in the US dollar, apart from the US economic fundamentals, is, of course, the US's role in the world. I mean, just think about how the confrontation with China will play out in the long run. I mean, there is even a chance of a military conflict with China at some stage, say over Taiwan. What would that mean for the stability of the dollar? What would that mean for the world? Would they still try to actually group behind the US if the US loses its position as a kind of global policeman? So all of these geostrategic questions play into that. And again, it's something for economists that's actually quite hard to predict, and certainly timing-wise.
And a lot of, I guess, why geopolitics is important is that, and I've heard someone say this, I can't think of who it is, but the currency is meaningful. The US dollar is meaningful because it's not necessarily backed by gold, but it's backed by people with guns. And that's ultimately what the issue is here, right?
Yes, and I think that was one of the reasons why the euro never really had a chance to replace the US dollar, because it doesn't have to be guns, of course, but it has to have the backing of a political institution with a significant weight. In the case of the euro, of course, with a European Union of 27 members now, fewer, of course, in the Eurozone itself, but there was never this political backing, this political project, let alone the military might behind it that would have previously supported the US dollar as the world's lead currency. It does take both. It does take economic power, and it does take political power together, of course, with a military might.
Yeah, got it. I want to talk about inflation now, if we may, because and we have loosely been talking about inflation the whole time here. Really, inflation is one of those important things. It's a risk, really. It's a risk that everyday investors have, that there will be inflation in the future, because out of all the investments that we have, they're denominated in currency. They're denominated in dollars. Those dollars can be manipulated. Therefore, we have to get a rate of return. A lot of us looked at the returns we've got in the last 12 months, for example, and think we're doing really well. Are we actually just seeing inflation, or the first stages of inflation?
Well, I'm pretty sure that we are seeing the first stages of inflation. I don't like the way the word inflation is typically used. People confuse it with the consumer price index. And in some ways, of course, the two go hand in hand and they go along for some time. But I think what we've seen in the last few years is actually that the consumer price index has been basically decoupled from inflation. Inflation, for me, as an Austrian school economist, is really money supply. And on the money supply front, we have seen a massive increase and therefore massive inflation. Whether that gets reflected in the consumer price index is a completely different matter. So far, what we've seen is that the money has gone into assets, it has gone into the property market, especially in New Zealand. It has gone into the stock market, it has gone into anything that you cannot easily replicate, because people are looking for a safe haven for their investments. So it's gone into even rare wines and whiskeys and arts and classic cars and anything that a central bank cannot just inflate away. And I think if we have more of this quantitative easing, more of this pandemic stimulus, we will see these trends continue. What could happen, though, of course, is at some stage that this money goes out of these assets and starts to go into circulation. And what I'm picking up from banks is, of course, that is the moment they're all afraid of. They say, okay, as long as the circulation, the velocity of money is not that fast, we'll be okay, because people won't actually notice it as much in their day-to-day affairs, that there is this inflation as in a CPI index increase. But once the money actually goes out of assets and goes into general circulation, we'll definitely feel it.
Okay, so now I want to just talk about this concept called modern monetary theory. And I think we often forget that word theory with a lot of things. Like, it doesn't matter what it is. There's laws, things that are true, and then there are theories. So modern monetary theory, we'll talk about what that means, and I guess another way of describing what that is, because there's another side to all of this where there's this assumption that you can just print your way out of any trouble you get into. So to start with, Oliver, can you just help me define what modern monetary theory is?
Well, the idea with modern monetary theory is that as long as you have control over your money supply, say you're a nation state, you have sovereign control over your central bank, you're fine, you're safe. That's what the proponents of modern monetary theory are trying to tell us. So you don't have to borrow anywhere internationally. You can just print your new dollars. And for a country like New Zealand, of course, we have New Zealand dollars, so only New Zealand can print them. So you're fine, all okay. The central bank can always bail you out. That's roughly the gist of modern monetary theory. I don't think the term is correct, because it's neither modern nor monetary nor theory. It's not modern in that sense, because actually it's been tried many times before. It's been tried in Weimar Germany or in Venezuela or in Zimbabwe. So countries have always tried to basically bail themselves out via the central bank. So nothing modern about it. Actually, nothing monetary about it either, because actually what these people proposing a theory have in mind is something more fiscal. So they think the government can spend as much as it likes. No problem. Nothing constraining government growth and government spending, because the central bank can just come in, print the dollars, and hand them over. So it's actually a fiscal concept. It's effectively saying government can just borrow as much as it likes, because the lender will be the central bank. And theory, well, I don't really think it's supported by monetary theory at all. Actually, I think most modern monetary theorists are pretty united, actually, in saying that this kind of perpetual motion machine doesn't work and cannot work. So it's not really a theory either. It's not a kind of brand new intellectual construct. It's more like a recommendation to governments that we think you can get away with that. So nothing modern, nothing monetary, really nothing theory. I think this is quackery. This is snake oil. And unfortunately, we've seen this before. It hasn't worked. Now they're trying this again under a new label. I don't even want to say good luck, because I don't want to encourage anyone to really try this, because I think the results would be disastrous.
We're basically trying to bring forward stuff from the future to today when we create more currency. Is that another way of looking at it?
Yes, basically that's what it is, because you can only really spend what you've earned before, and they're trying to create an illusion that there is an endless supply of money and no scarcity of anything. And if we know one thing in economics, of course, economics is the study of scarcity and scarce resources. Well, just to pretend that scarcity doesn't exist, because we can just print money and print paper and say this is money now, and you have to accept this, and this is worth a lot. Well, this is just a nice kind of little theory, but it's simply not borne out by the facts. So I think it's grossly irresponsible, and governments would follow these prescriptions at their peril.
Right. Effectively, it's a hallucinogen, a monetary hallucinogen.
That's a good way of putting it. Yes.
Yeah. So what would be some of the outcomes here? Like, obviously, we would love to think that this will work, right? And I personally, when I boil it all down, I still have hope. I still am an optimist in that we will return to some form of equilibrium again, maybe with some higher prices, and things will stabilize. That's kind of the world that I can kind of see coming. That's what I'm hoping to see happen. And if that happened, then that's great. Maybe modern monetary theory works. Maybe we can actually just change the operating system and create an illusion, and we're happy, and we're in a state of bliss, and that's fine. But if it doesn't work, if the theory proves to be very false, then what are we going to expect? And I know we've kind of loosely touched on this before, but what are we going to expect, again, from the concept or from the perspective of an everyday investor who's trying to repay their mortgage? They're trying to build up their KiwiSaver balances. They're trying to earn money and just survive, really. What are some of the risks that we have as everyday people here, because this theory seems to be adopted more and more?
You actually suck the dynamism out of the economy, because with every intervention we've had in the past, we have seen more of the zombification of the economy. We have seen our productivity levels decline. There's hardly any productivity growth to speak of anymore. So the dynamism goes out of the economy. The growth rates go out of the economy, and that will, of course, make it even harder to get real yield on your investment. So that is the problem that I see. And if you want to see one country that really exemplifies this quite nicely, it's Japan. So Japan has been in this paradigm really for the last almost 3 decades. So they've had a massive stock market crash, a massive correction in property values, especially in Tokyo, of course. And then the Bank of Japan flooded the market with more money and liquidity. And you can see that actually that hasn't really worked for the Japanese economy, because it has actually zombified large parts of it. And whereas previously, of course, I remember the 1980s, Japan was seen as a kind of model to imitate because they were so good and so innovative. Nobody would talk about Japan these days anymore like that. So if we want to turn the whole rest of the world into some kind of Japan, we'll have to continue this monetary activism. But if we see Japan as a kind of a warning, what happens when you rely too much on easy money, then I think we have to change course, and we have to actually return to some sort of monetary normalcy and stability that we used to have, at least in some countries after the Second World War.
Is it possible for us to return to that place of, getting more independence from central bank and government, where there's a focus just on price stability? Is it possible to bring some common sense back into this space and some stability? Maybe that involves returning to a gold standard of some sort. I don't know. But is it possible?
It's a question of political will. So, of course, it's possible. It's happened before. Look at what happened in the US under Fed President Paul Volcker. It was not very popular, increasing interest rates to fight inflation, but it worked and it had to be done. It was the same story, of course, in post-war Germany. It was the same actually in New Zealand after 1984. These measures are painful when you take them, but of course you can create monetary stability if you really want to. Sometimes it's not so much a question of whether you want to, but whether you have to, because you cannot as a society tolerate long periods of really high inflation. So at some stage you have to intervene and you have to take the painful medicine and actually cure your monetary system. Whether it's a return to the gold standard, I don't think that's likely, even though it might be desirable. But at the very least, we could actually return our central banks to a pure focus on monetary stability and free them of all the other nonsense we've actually burdened them with, because that's actually none of their business. For that other stuff, we have politicians. And reserve banks, central banks more generally, their only focus and their only target should be price stability.
Cool. Okay, so I've got 2 more things that I just want to quickly finish up on before we go. Housing has obviously been really topical in the last 12 months, this housing crisis situation. And I want to kind of draw some sort of link between the discussion that we've had so far around money versus wealth, currency versus economic recovery, and all that sort of stuff. Housing has become a lot less affordable, sustainable, all that sort of stuff. And there's a whole lot of commentary about that right now. And there's attempts with government to try to solve the problem using taxation mechanisms, especially. What do you see as the most common sense thing to do in an attempt to create more common sense out there? Let's give the politicians some common sense right now. What should they be focusing on to solve a so-called housing crisis right now?
You have to look at the supply side of the market. The reason why we see so much money flooding into the housing market is because investors know that the housing market is supply constrained. And therefore, there are good yields to be made. If we relax supply, if we make supply more flexible in the housing market, of course, the extra money flooding into the market would actually yield to a higher output of new homes. So that would go into construction. But because we cannot actually increase construction as much, prices go up. And that's basically why we see so much speculation about housing. So for anyone conversely interested in making housing more affordable, you have to make sure that supply can go up when money floods in, that supply actually goes up when demand is higher. And there are some countries in the world that have actually done this much more successfully than New Zealand, and have built more per capita over long periods of time, have managed to keep their housing market stable over long periods of time. And I think these methods of actually keeping housing affordable in the long run are out there. We just have to rediscover them.
And do you think that because obviously it takes time to increase supply, and part of the reason why supply is slow to come online is, again, because of more regulation, which sometimes isn't fit for purpose. But granted, it's going to take some time to get supply online. Do you think that it's appropriate to say, hey, we have seen insane house prices in the last 12 months, acknowledge the fact that, it's not fair, definitely not fair. But given the situation that we're in, and it takes a while for the supply side to kick in, which ultimately is the solution that you're referring to as well, is it appropriate for us just to get over the fact that house prices are crazy right now, or they feel crazy?
Well, I think, as you say, supply takes a while to materialize. However, if you already signal quite clearly that these supply changes are coming, people will already factor them in when they're making decisions, investment decisions. So if a government credibly commits itself to increasing supply, even though the supply might be a few years away, it would already have a price impact. We know this actually from monetary policy. We know this as rational expectations. People factor such things in. So I think what really matters is now that the government actually quite credibly says we are going to reform the Resource Management Act. We make it more supply friendly. We'll also make it easier for councils to deliver infrastructure for new housing developments. And by making it easier, I mean, actually we provide some funding for that, because that's actually what's holding councils back. Councils can't afford the infrastructure that goes with new development. So if we had these policies that actually send a very clear signal to the market, something's going to happen, we'll increase supply, we'll basically take care of the prices as well.
Okay, cool. And then lastly, I want to talk about education, because I know education is one of those things that the NZ initiative is quite actively involved in. And, we've got the curriculum, and then we have the assessment. It's way beyond the area of my knowledge. I'll confess that right away. But what I am specifically interested in is, in the context of building wealth, some of the fundamentals don't appear to be out there in terms of the curriculum, specifically economic history, for example. And I'm thinking about, the convergence between economic policy and just political structures in the past. A lot of the new generation, and maybe this is one of the reasons why modern monetary theory is so easily adopted today, is there's this inherent faith that the government will have our best interest at heart all the time, and they'll take care of us. When we look to history, the more power that governments have, the less that can be seen to be true. Do you have any comment around what we are teaching in the school system at the moment in that sort of context? I know that's a pretty crazy question for me to throw at you, and there's a lot of layers to it, but do you want to speak to that in any way?
I can only answer this really from a personal perspective. So I grew up in Germany, in West Germany. I was born in 1975. I spent my first 14 years in a divided Germany, where one part of the country was basically a capitalist economy, West Germany, that's where I lived, and where the other part lived under communism. And between them was a wall, the Berlin Wall, and the country was divided, and we lived in the Cold War, where, there was a possibility of a nuclear war anytime. So I remember that. And I come from a country, of course, where my parents told me about the post-war years and how they experienced that, and where my grandparents could still tell me about the war, and where families had memories of hyperinflation. So this was a growing up in a country that was shaped by some pretty severe disasters. I mean, National Socialism, the Holocaust, then the Cold War, the division of the country, in between a few hyperinflations. It was impossible growing up in this kind of scenario without having an interest in history and in politics and in political philosophy and theory. And I think it shapes you. And I only visited East Germany once. I went to East Berlin and I had a look around, and I was 13 at the time, but it had a lasting impression, because you come from West Berlin, and West Berlin was basically capitalist and colorful and really interesting and vibrant. And then you cross the border and go into this gray and beige East Berlin, and with police on every corner, and the shelves are empty in the supermarkets. It had a lasting impression on me. And I think if you're a younger member of the younger generations today, you haven't experienced this, and you only maybe know this from the history books, if you even have history books at all, you would not be able to really understand what socialism is and what a threat it can be. So I think history education is absolutely vital. It's crucial if we want to shape our future. I think it was Helmut Kohl, the former German chancellor, who once said that a people who doesn't know its history cannot understand the present and cannot shape the future. And I think there's a lot of truth in that. You have to know history to even understand where you are, but you definitely have to know history to avoid making mistakes in the future.
Is this being taught at the moment? Is economic history or history of that type, is that being taught right now? And I know, I'm sure in some areas it is, but broadly speaking, is that actually being taught?
No, it isn't. History is not compulsory in New Zealand. You will, of course, over your school years encounter some history, but the government's only just now trying to formalize this into a New Zealand history curriculum. So this will only deal with New Zealand history, not with world history. And you can actually see this reflected in opinion polls and surveys. So not just in New Zealand, in Australia, in America, it's exactly the same pattern. You ask the younger generation and they basically know nothing about history. What they do know is they know something about Hitler. That's probably because Hitler is a figure that you often encounter in movies or on the History Channel. But you wouldn't actually know much about Stalin or Lenin or Mao. You wouldn't have any knowledge of that. Then you ask the younger generation whether socialism is a great idea, and majority actually in all three countries I mentioned say that, yep, that is something worth trying. But they wouldn't even be able to define what it means. You ask for any knowledge on historical figures or historical events, and typically you don't find much knowledge at all. That's a worry. We have to change this, and I think this country deserves a proper curriculum, not just for history, actually for geography as well. I think would be quite nice, for mathematics, for all the other classical subjects that we typically teach at schools, but especially for history. I think if you lack this historical knowledge, you are bound to make mistakes.
That's really good. And I think just in the context of understanding economic cycles and just investments generally, you have to have an understanding of history. And I know myself personally, I totally recognize that my formal education was deficient in the area of that. And hence, that's one of the reasons why I probably have more of an appetite to learn about that now, as I'm kind of trying to round out my understanding of how the world works. But I just find that really concerning that, the current generations seem to have this natural affinity towards something which in the past has proven extremely harmful. Yet we're almost going through that cycle again. And that's kind of, I guess that's, history doesn't repeat, but it often rhymes, right?
It does. More generally speaking, I think actually history is one of the most interesting things you can study. It is just fascinating to see where we come from, quite literally. And I've got an 8-year-old son, and we read history books quite a few times a week together. And he finds it interesting. And he is fascinated by things like the Roman Empire and Julius Caesar and Cleopatra and the Middle Ages and knights. There's so much stuff in history that I think if you make it interesting and if you tell your stories properly, the children will find really engaging and interesting and, well, thrilling actually in parts. So I think it is a mistake not to subject our younger generation to all of these various aspects of history, because I think there's so much to discover. And once you've done that, you know your place in the world.
Fantastic. That's awesome. Well, this has been a really interesting discussion. It always is. And if nothing else, I've definitely got a few notes here that I'm going to follow up on later on with you in terms of another episode that we can potentially do. And if people want to follow what you guys are up to at the NZ Initiative, what's the best way for people to kind of understand what you guys are about and what it is that you do?
Easy. You go to our website. It's nzinitiative.org.nz. We'll have a weekly newsletter. It's called Insights. You can subscribe to that. It's free. We have a podcast where you can sometimes listen to conversations like the one we had today, where we have podcasts with our researchers in the office. Yeah. And of course, all our publications, everything we've ever done over 9 years is available free of charge on the website. You can just download publications on whatever you're interested in, from education to fisheries management, housing, and local government. There's something for everyone.
Fantastic. No, that's awesome. Okay, well, thank you very much. Really appreciate your time. All are very, very generous of your time. Very punctually, we're going to finish within the hour, well and truly here today, so that will appeal to the German side of you. So that's fantastic. Have a great weekend.
Thank you. You too. Bye-bye.
All right. Thanks very much. Cheers.